In this week's video, we'll cover a superfecta of recent developments to help us answer the question, do these facts lean bullish or bearish? Before we get to the charts, let's emphasize one of the important concepts covered in an April 30th short takes post. Charts cannot predict the future. They simply help us assess patterns in human behavior from a probability perspective. This is a weekly chart that tracks the performance of stocks relative to bonds. We're using mutual funds as a proxy for the SPY relative to TLT ratio in the ETF world. We'll start in Q4 of last year and walk forward to the present day. In mid-October, we had a bearish MACD cross above the center line, and we know that that tells us from a probability perspective that this could be, or most likely is, a counter trend move within the context of an ongoing uptrend. Then in December, a month that turned out to be the worst month for the stock market dating back to the Depression era, those probabilities shifted when weekly MACD for the stock-bond ratio dropped below the center line, telling us from a probability perspective we should respect that it's possible that the primary trend has now shifted from up to down. In Q1 of 2019, we had a bullish cross that occurred below the center line, and then the stock-bond ratio recaptured the center line relative to weekly MACD. And if we fast forward to the present day, we just nailed down the fourth consecutive weekly close above the center line on the weekly MACD. And an important part of our study here is this is an intermediate term shift. In the present day case, weekly MACD stayed below the center line for 112 calendar days. Thus, when we looked for historical cases, we wanted to do somewhat of an apples to apples comparison. So we looked for similar cases where MACD on a weekly basis stayed below the center line from anywhere between 90 and 180 calendar days. So as we have done numerous times over the past 4 months, we have a factual setup in front of us, something that has already happened in the present day. We're going to ask, how many times has something similar happened in the past, and what happened next in the stock market? In this case, we have data going back to the late 1990s. We're looking for similar cases. Bearish cross above the center line, drop below the center line, then get a bullish cross and above the center line in close proximity, and then close above the center line for at least 4 consecutive weeks, with the duration of the drop below the center line falling into this window here. Historically, there were 4 cases. First one occurred in 1998, the second setup's in 2004, followed by 2010 and 2012. Very, very similar to the message we've been delivering in recent weeks. Somewhat of a coin flip look for the S&P 500, looking out 90 days, but from a longer term perspective, the odds and the returns start to improve significantly. In the 4 historical cases, 18 months out, every single case was green, with the average and median gains in the S&P 500 hovering around 14%. If we go out 2 years from this date here, which is similar to the present day, the average gain was roughly 19%, the median gain around 18%, and once again, all 4 cases were positive, telling us to keep an open mind about better than expected outcomes over the next 1 to 2 years, while having realistic expectations about consolidation or givebacks over the next 90 to 180 days. basically take the same approach here. This is the Vanguard Information Technology ETF VGT. This is a monthly chart. At the end of April, bullish MACD cross. Don't have data going back that far, but it still might be helpful to know how the markets reacted after the 4 previous bullish monthly MACD crosses. The present day cross is only the 5th cross in the last 13 years. So in the next slide, we'll be looking at how did the market do going forward from this point, this point, this point, and this point, which is similar to this point. Very, very similar message. Over the next 30 to 90 days, we should have an open mind about consolidation and normal volatility and givebacks, somewhat of a coin flip over the next 20 to 30 days, but the longer term outlook very favorable from a historical perspective. 2 years out, the SP 500 was up 32% on average, the median 32% gain, with all 4 cases posting positive returns. If we look at NASDAQ performance over the same periods, similar, have realistic expectations about the next 90 days picture. And the historical results also tell us to keep an open mind about much better than expected outcomes over the next 180 days, all the way out to 2 years. The average gain, 46% 2 years out. The median gain, 46% 2 years out in the NASDAQ, with all 4 cases posting very favorable and impressive returns. Once again, the historical analogies don't predict anything relative to 2019. They simply help us assess patterns in human behavior from a probability perspective. When human behavior and shifts in attitude caused a similar bullish cross on this chart on MACD in the 4 previous cases, the pattern from a historical perspective was clearly bullish in the S&P 500 and even more so in the NASDAQ. And you might be tempted to look at monthly MACD and say, ooh, this is really, really extended and overbought. But we have to keep in mind, MACD is not a bounded oscillator from stockcharts.com. Because MACD is unbounded, it is not particularly useful for identifying overbought and oversold levels. In keeping with the Superfecta theme, we've covered numerous forms of breadth thrusts over the last 4 months. I believe the first one we covered was way back on January 19th or 21st-ish on short takes. To date, they've all been extremely helpful. Similar situation here. We're looking at a chart from the Bird Strike Arsenal. This helps us with overbought and oversold. This monthly S&P 500 breadth momentum oscillator hit an oversold level that's only been seen 4 previous times. We have data going all the way back to basically the beginning of 1999. It's extremely rare to be down in this territory and then shoot back up so quickly. Similar situation here, 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 and here. And if you're experienced in technical analysis and using overbought and oversold indicators, you know that oversold markets can continue to decline. Oversold markets can continue to decline. Thus, we will not be using charts like this as a timing tool. This is a pay attention tool. We're extremely oversold. We should be open to a rally. We're extremely oversold. We should be prepared for and open to a rally in the S&P 500. If we've only been down in this area 4 previous times dating back to 1999, it might be helpful to know what happened next in the S&P 500. The 11/30/2001 case reminds us that oversold markets can continue to fall. However, using this as a pay attention tool eventually became extremely helpful. Using this as a pay attention tool eventually became extremely helpful. And if we look at returns from this point here, this point here, this point here, and this point here, all four are similar to this point here. We can see that all four historical cases were green 3 years out. The average gain 4 years out, roughly 47%. The median gain, roughly 49%. Average gain in the S&P 500 5 years out, roughly 70%, with the median gain coming in somewhere in the neighborhood of 75%. If we're going to nail a superfecta, we've got to keep moving along. We'll walk through this very quickly. Bear with me. S&P 500 Weekly, present day over here, May 3rd, 2019. A refresher. We made a new all-time high on the weekly chart of the S&P 500 in early 2018 and then experienced a 10% decline. That was followed by a sharp rally to new all-time highs in September of last year, only to be followed by an extremely rare plunge in the neighborhood of 20%. That was followed by a sharp reversal, and in the present day, we've printed once again a new all-time high. Weekly MACD, we had a bearish cross above the center line. We had a bullish cross near approaching the center line, telling us that momentum is vulnerable here, more vulnerable than it was here. Then we get a second bearish cross above the center line, and then we drop below the center line to be followed by a bullish cross below the center line, and we just printed the 10th consecutive weekly close above the center line. We said charts can't predict the future. They help us assess patterns in human behavior from a probability perspective. We said this was an extremely rare plunge here, given a 10% decline occurred earlier in the calendar year. Can we find a historical case that can check basically the same 13 boxes? The answer is yes. We could basically walk through all 13 of the boxes. A new high was made here, followed by a roughly 10% decline, a sharp rally to a new all-time high, then a plunge somewhere in the neighborhood of 20%, followed by a sharp reversal and a new all-time high. Weekly MACD, bearish cross above the center line, bullish cross near the center line with waning momentum, bearish cross above the center line, drop below the center line, bull cross below the center line, and then 10 consecutive weekly closes above the center line. These are the exact same 13 bullet points that we used on the 2019 chart. This is also incredible from a similarity perspective. 2018, this is 10.16%. This decline is 19.78. What did these numbers look like in this case? Instead of getting a 10.16% decline, we had a 10.21% decline. Instead of dropping 19.78% from the closing high to the closing low, in this case, it was very, very similar, 19.84%. How is all of this helpful? It helps us understand a similar shift and pattern in human behavior. We are not using this and expecting the present day to continue to walk forward in the identical manner. In fact, we will not be watching this analogy day by day or week by week or month by month. But since human beings acted in a very similar manner here, it would be helpful to know what happened from this point here, April 5th, 1991, looking out several years. Very similar to the story we've been telling historically in recent weeks. Somewhat of a mixed bag over the next 90 days, but then green boxes from 180 days out all the way to 9 years out. Is it relevant to project the historical analogy out 9 years? The answer is probably not. And why are we doing it? Because it reminds us of two important points. Number one, short-term volatility doesn't necessarily derail long-term returns. Point number two, despite the way human beings feel on a day-to-day basis, the stock market, just the S&P 500, can produce eye-popping returns. We can make a third point. The miracle of compounding can do some amazing things over time. And while it may seem totally impossible for the market to produce returns anywhere even close to something like this looking out 2 to 9 years, this just happened in May of this year, and historically from this point, really good things happened on a consistent basis looking out 1 year, 18 months, and 2 years. Even in this case, 180 days out, the S&P 500 was up 11%. It had a give back, but eventually went on to print a higher high. Historically, when we get a MACD cross on VGT on the monthly chart, we just got one at the end of April. Historically, it tells us to keep an open mind about better than expected outcomes over the next 1 to 2 years. On our momentum oscillator chart, this is a fact. This is something that just happened in 2018 and 2019. And after similar and dramatic shifts in human behavior after extremely rare oversold readings, really good things happened on average looking out 3 years. Really good things happened in every case looking out 4 years. And incredible things happened in every single case looking out 5 years. There's something else on the May 3rd, 2019 chart that's relatively interesting in terms of history. If we draw vertical lines at this high here, so this is late January 2018, put a vertical line near the high on the weekly chart in September of last year, and then draw another vertical line on May 3rd, 2019. Here are the exact same spots from a proportion perspective on the 1991 chart. This is where the high was made in 2018 in January. Very similar spot. This is where the high was made in September on the weekly chart in 2018. Very similar spot in terms of proportions. And the same can be said for the present day. After this point here, not particularly impressive over the next 90 days, telling us to keep an open mind about givebacks and consolidation, but extremely impressive returns looking out 1 year to 9 years in the S&P 500. And if we wanted to get one more visual that says it's within the realm of possibility that something like this could happen. We all know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or a bearish breakdown. Covered this chart on April 11th, 2019. And if we look at the same chart on May 3rd, 2019, this still looks like a bullish breakout, a retest of these blue lines here. And as of May 3rd, it looks like a successful retest with price testing and holding an upward sloping 50-month moving average. David's tweet reminds us the good news. If you're a CCM client, we've been overweighted in large caps, and they have significantly outperformed. The reality check is no matter what the trend, there are always counter-trend moves, reminding us that technology and large cap growth stocks cannot outperform every day, every week, every month, every quarter, or even every year. Part of a sustainable advance, long-term advance in any market is sector rotation and leadership flips from time to time. It's also important to note we do not and have not made any decision in recent weeks or months based on any historical analogy. As of Friday, May 3rd, the present day data aligns with the historical data that we just covered. And the model tracks present day data. So let's check in on the present day data using the bull-bear roadmaps first covered on January 11th, 2019. On January 25th of this year, in a weekly video, we said we would learn something either way in this area here. If we fast forward to the present day, it's fair to say, from an observable and measurable evidence perspective, from this point here to this point here on May 3rd, 2019, it's very, very difficult to say that the present day looks like this case, really doesn't look like this case, and in this case we have a series of lower highs and lower lows that are congregating around a downward sloping orange 200-day moving average. In the present day, we have a series of higher highs and higher lows above an upward sloping and turning up moving average cluster. We'll continue to take it day by day. And another chart that we covered earlier in calendar year 2019 reminds us that it is possible for good things to happen for a long period of time, that it is possible for good things to happen for a long period of time when a market comes back and tags the 200-week moving average and rallies, tags it and rallies, tags it as of January 4th, 2019. This chart comes directly from the slides that we used in a weekly video, and this chart was used telling us to keep an open mind about much better than expected outcomes in the days, weeks, and months ahead. And back in early to mid-January, we said these were the looks that we wanted to see, that this was constructive when the S&P 500 was able to clear and hold above the orange 200-day moving average. Clear it and hold above it, clear it and hold above it, clear it and consolidate above it. These are the same moving averages as of May 3rd, 2019. The data that we have in hand as of this recording does align with many of the historical analogies which are telling us keep an open mind about normal and 100% to be expected consolidation and givebacks over the next 90 to 100 days, but we should also keep an open mind about much better than expected outcomes over the next 1 to 2 years. Good things happen from this point here, from this point here, from this point here, and this point here, telling us to keep an open mind about good things happening from this point here and this point here. And in every single case, there was sideways movement and consolidation, some sideways movement for several weeks and a give back here, a give back and a retest, several weeks of consolidation before the bullish trend resumed. Clarifying what we said earlier, the first breath thrust article was posted on Short Takes on January 21st, and we said that the imbalances spoke to investor psychology, prior concerns prior to the thrust, and the present day interpretation of the shift in the fundamentals or perception during and after the thrust. In conclusion, not much change to the bullet points that we've covered in previous weeks. Based on the facts in front of us today, the longer-term outlook remains favorable. Short term, we have to have realistic expectations about a 4 to 10% pullback. We are not using any of this to forecast anything, meaning we have to head in to next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.